What are the most common mistakes landlords make when setting up limited companies? Do you know about double taxation, or why it's important to have the correct articles of association set up? How about whether a limited company is right for you, or if actually you'd be better off investing in your own name?
In today's episode of the Property Tax Show, we'll answer these key questions, and I'll also cover the most common issues I've seen when landlords set up a limited company.
Hello and welcome to the Property Tax Show. I'm James Poyser.
And I'm Nadeem from Provestor, the property accountant.
Now, Nadeem, you're an experienced property investor. You are a qualified accountant and tax advisor, but most importantly, you are our head of tax here at Provestor, so you know a thing or two about property tax. So in which case, I've got a good question to start off with, Nad. 77% of buy-to-let properties are now bought through limited companies. So in your opinion and experience, should that be 100%?
Great question, and one of the most common questions we get actually asked, James, by clients, because as you'll know, Section 24 since 2016 has pushed a lot of people towards thinking about using limited companies, and actually it's very beneficial for a lot of our clients. But in answer to your question, it's not necessarily the right thing for everybody.
Right. Okay. So feels like a bit of a cop out. So it might not be right for everybody. So what broadly speaking, who's it right for? Who's it not right for?
Yeah, and it does feel like a bit of a cop-out because it is a case-by-case basis. Right. But ultimately, the conversations we'll have with clients at this stage is understanding their long-term plans, because a lot of it comes down to what their portfolio growth plans are in terms of the benefits of a limited company. Again, as we've discussed, Section 24 has a major impact on people wanting to use limited companies. And that really depends on the levels of profits that they're earning in their personal portfolio, and indeed what their plans are to grow their portfolio in the future. So if you're quite happy with your portfolio as it stands now, and you're not pushing yourself into becoming a high rate earner, i.e. 40%, then actually there's potentially nothing wrong with you continuing your portfolio growth in your personal name, so long as you don't exceed that value. In addition, there are other things to consider when moving or indeed buying properties in a limited company, things like lending. So mortgages, getting mortgages can be a little bit more tricky, can be a little bit more expensive in a limited company, which of course, clients won't be aware of until they're at the final stages of the purchase, in which case it can be a little bit too late. So there are a number of things to consider for clients, and it is unfortunately a case-by-case sort of conversation that needs to be had. Yeah,
okay. So it sounds like it's quite a big decision, quite a few things to consider. So you allude to the fact that if you're a basic rate taxpayer or if you've got a smaller portfolio, a limited company might not be right for you because of the complexity and the costs don't outweigh the benefits. So on the flip side of that coin then, Nadeem, who would it be right for? Is it the clear cases where you think actually, you probably should be thinking about a limited company because by the time you've added in the costs and the extra effort, it still makes sense for them to do it?
Of course, absolutely. So it is kind of flipping what I've just said there. So you're looking at those people who are now being impacted by Section 24 or now high rate earners. So those who were previously paying 20% tax in their personal name are now paying 40% tax or even 45% tax. And actually then the use of a limited company or for the future growth of their portfolio growth in a limited company at 19% is effectively, very beneficial. And, the costs, absolutely the point you just mentioned there, far outweigh, continue buying a portfolio in your personal name. We always be very transparent with clients and tell them that actually having a limited company has costs itself, whether it's your accountants or opening a business bank account. These costs are something that needs to be factored in, but normally are far outweighed by people who are high rate earners.
So if you're talking about higher and additional rate taxpayers, that's 45% tax versus corporation tax and limited company is 19%. Right, so that's quite a big difference. And is that it? Does that where it's end? Is it as simple as that? 45% versus 19%, limited company, it's the way to go.
Yeah, we wish. Unfortunately not though, because there is something called a double taxation issue that we do need to consider here for clients. And this is something, again, when we have a conversation with our clients, is that we make them aware that yes, 19% is great within a company, and that's whether you make £1 profit or £1 million profit, it's always 19%. But there is a further tax to consider when you actually take that money out. So again, when we have a conversation with the clients, we understand what their plans are in terms of actually, do they need these profits to live on day by day, or is the plan to actually just grow the portfolio, in which case you can keep a lot of your profits within the company, in which case 19%, fantastic. But if you then tell me you need to get majority of that money out to live on, then we need to have a further conversation about further taxes when you actually pull money out of this company.
Okay, so that's double taxation. Are there any other tax considerations, any other differences, particularly when you're, say, buying a property or selling it when it comes to limited companies?
Yeah, so of course we've got stamp duty, which we can't get away from, whether it's in your personal name or in a limited company.
So limited company, you still have to pay stamp?
Absolutely, yeah. And as our viewers will know, the 3%, which is applicable in their personal name, still applies within a limited company, whether it's your first property purchase in the limited company or whether it's your fifth. So the 3% surcharge will remain. In addition to that, we have also capital gains to consider in a limited company, which many of our clients have asked this question to me in the past in terms of understanding capital gains in a limited company, and the calculation is pretty much the same in terms of how capital gains tax is worked out. But of course, as you know, companies don't pay capital gains tax, they pay corporation tax.
Okay.
So the principle of capital gains tax does apply in a limited company, but we'll probably go through that in another show.
Yeah, because I guess that's that applies when you're selling the property, and I guess we're going to have a discussion about the different rates and how it's calculated. And that sounds like a whole episode in itself to talk about disposing of property. Okay, great. So that's the major differences covered. Now, as we said, now you're an experienced accountant doing this for some time. You must have seen a few mistakes along the way in terms of people setting up limited companies and not quite getting things right. So, in your experience, what are those things that you've seen?
Yeah, so we have clients who make very common mistakes, and one of the most common one is setting up the company with a wrong SIC code, or otherwise known as a SIC code, and this is a code which is reflected on public record on Companies House website, and it's a code which reflects what the business does. So it's what its trading activities are, and the reason it's important is because it's one of the main things lenders will have a look at before they kind of approve any mortgages. So they want to understand that the company they're lending to is all set up correctly, and of course the shareholders' directors are all set up correctly. But if the SIC code is not correct, then sometimes that can have a bit of a bounce back from the mortgage people. It's a quick fix, but it's a conversation and a transaction you don't really want to be dealing with at a point of getting a property over the line.
I guess in the heat of the moment of doing the deal, the last thing you want is something, a trivial mistake like that's going to take a bit of time to get fixed. And I guess so. You mentioned the codes. Is there a couple of codes? How many codes we're talking about?
Yeah, so we have typically 2-3 codes, which is for your buy-to-let portfolios or your people who flip properties, buy and sell properties. But actually, as time has gone on, there are further codes which have come out for people who now do furnished holiday lets, whether that's a Airbnb, Booking.com, so there's different sort of versions of these properties that are on the market. So again, having the right SIC code and making sure you get advice on that is quite important, because depending on what type of business activity you're doing, and it could be more than one type of business activity, it's key that all those are reflected on the Companies House website. So
that's the first common mistake that you see, SIC codes. What else?
Another common one, I guess, is timing. So people actually getting their company set up in the right timely manner and order. So ultimately, going to a solicitor to get a property completed is the normal route, but having your bank account set up and having your deposit in place is another question. And unfortunately, when it comes to a limited company, getting the bank account set up is not as straightforward, as quick as it used to be. And of course, setting a limited company in the right fashion as well. So again, when we have the conversations with clients, we say, before you're getting close to buying a property, get the company set up in the right fashion, get your bank account set up, and then have the deposit in place. So actually, when you are going out to auctions or your local estate agent, you're pretty much ready to go.
It sounds like, and kind of build on the point that you said before, it sounds like if you're serious about investing in property, you think limited company is right for you, it sounds like you need to kind of take a breath, think about it, get some advice, figure out if it is right for you, and if it is, get things in place sooner rather than later, because when you're there, as we said, in the heat of the deal, you might be in an auction, you might have found that perfect property. You want to make sure that you're ready to close that deal and nothing's going to stand in your way. And I guess that's the kind of the point that you're making, is make sure there's no hiccups along the way in terms of bank accounts or conversations with lenders and getting prepared.
Absolutely.
Okay, so that's the timing piece. SIC codes. Any other mistakes that we see?
And this is something probably a little bit more in the background that people are not really aware of, which is articles of associations, and these are sort of the memorandums of your company. So they reflect sort of who runs the company, who controls and who governs the company. And again, this is going back to having the right directorship, the right shareholdership in place. And we're finding this to be quite a common question now, because we have a lot of investors who invest with overseas individuals or overseas companies indeed, and so having your right levels of protection are becoming more important, and your articles do reflect that. So your articles reflect how the shareholders want the company to be governed in terms of what the directors can do, what they can't do, and actually how the company is run and controlled ultimately. In addition to that, we have something called ABC shares, alphabet shares, which we've discussed before. These shares have different rights and voting rights and obligations and control of the company. And if you've got such shares in place, then again, these articles will stipulate what each share class can do and can't do. And again, very important when you're working with maybe unconnected people. So it's not just husband and wife or father and son, mother, daughter. When you're working with unconnected people, you really want to have an exit strategy in place to understand what your shareholding can do and what it can't do.
Yes, and I guess you mentioned alphabet shares there, and I guess things like smart structures with freezer and growth shares seem to be very popular at the moment. I assume this advice also applies for that as well. Is that if that's the strategy, you need to make sure your articles are right.
Absolutely. So for freezer and growth shares are something which potentially can impact you now or can impact your shareholding value further down the line. So again, having the right models of articles in place from day one is critical. So those shares can represent what you wanted from day one in the company.
Yeah, and I guess with all of this, the thing you need to keep in mind is the fact that you've got to consider the value of your portfolio in the future. You know, you would hope, and it's relatively realistic in a decade's time, you could be sitting on a portfolio that's worth a seven-figure sum, and that's the time that you don't really want to discover that a mistake was made earlier on in the lifetime of setting up that company. Again, so it goes back to that point of, if you think it's right for you, step back, get the advice, get things done properly, and make sure you're prepared for your future plans for investment.
Absolutely, and again, a lot of our clients go into these ventures with a lot of gusto, and of course that's a good way of going into it. But what they don't realise that profits can increase, quite quickly in a short frame of time. So having a company set up, and having all your protections from day one is very important, because it could well be that in 12 months' time you're having a very sticky, awkward conversation with your fellow shareholders, whether they're family or unconnected people.
Yeah. Brilliant. Okay, I think that's everything, Nadeem. Hopefully that's been a useful little conversation into starting up a limited company for landlords. So if you've liked this, please take the time to hit the button to subscribe to our channel and set up an alert. If you have any questions, put them in the comments below, and I'm sure, Nadeem, you're happy to jump on there and give the advice where you can. That's it from us, and hopefully we'll see you next time, where we're going to be talking about how to get profit out of your limited company.